Welcome back to Investing Talk podcast.
Today we're looking at Sellas Life Sciences Group.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Yeah, we really appreciate your support.
It definitely helps us keep bringing you these in-depth market analyses.
For sure.
So to kick things off today, we are staring down what I can really only describe as a glaring paradox.
It's a big one.
Right. We are looking at a completely pre-revenue biopharma company. Yet the stock has just absolutely exploded. I mean, we are talking about a surge of over 200% in just the last 6 months alone.
Which is massive.
And it just recently hit a new 52-week high of $5.42. That was on March 3, 2026.
It is the ultimate biotech dilemma, isn't it?
It really is.
You have an enterprise that is essentially incinerating cash right now, just burning it,
Yeah.
generating absolutely zero current sales. But the market is pricing in this monumental expectation of future success. That 200% run-up we are seeing, it's almost entirely driven by the anticipation of what is waiting just around the corner.
And that actually brings us to our primary mission for you today. We need to navigate the immense volatility surrounding this stock. Just to put a concrete number on that volatility for you, the beta is currently sitting between 2.27 and 2.63.
That's high.
Extremely high. For those tracking the broader markets at home, a beta of 1 moves in tandem with the S&P. So a beta over 2.2 means this stock is moving more than twice as aggressively as the rest of the market.
In both directions.
Exactly, in both directions. So we are here to figure out the truth. Is this a genuine breakout oncology star that you absolutely need on your radar, or is this just another speculative trap ready to catch late buyers holding the bag?
Yeah, that beta is definitely no joke. It means the swings, whether we are talking about euphoric rallies or just crushing sell-offs, they are going to be violent. But what is truly fascinating here is the underlying engine driving that movement. It's all about the science they are developing.
And the impending deadlines surrounding it.
Right.
Well, let's unpack the fundamentals, because before we get swept up in all the clinical hype, I really need to look at the actual foundation of this business. As the skeptic in the room, the raw numbers here are frankly terrifying.
I know.
There is currently zero meaningful revenue coming through the door.
True.
When we look at the trailing 12 months, the net income is a painful negative $26.26 million. The earnings per share sits at negative 0.722 cents, and they are burning cash at this rapid, unrelenting rate, over $25.9 million in outright losses. As a result, the free cash flow is entirely negative. Every single dollar they have is being poured straight back into these clinical trials. So from a traditional value investing standpoint, this looks less like a business and more like a financial black hole. So convince me otherwise.
Okay, fair. If you judge them strictly by the standards of a mature blue chip company, you are completely justified in that fear.
Right.
It looks bleak. But you have to understand the business model of clinical stage biopharma. We have to understand the why behind that $25.9 million burn rate. This isn't wasted capital going toward, lavish corporate retreats or something.
I hope not.
It is a highly targeted investment into building a formidable competitive moat. They're constructing an absolute fortress around their intellectual property, specifically for WT1 targeted immunotherapies.
Okay, let's pause right there, because WT1 targeted immunotherapies sounds great in a press release, but what does that actually mean? Break down this competitive moat for us.
Gladly. They essentially have two flagship assets that make up the core of this entire operation. The first is called GPS, which is a multipeptide vaccine. It is currently in a critical phase 3 study called REGAL. The second asset is SLS-009.
And what is that?
That one is a CDK9 inhibitor.
All right, for those of us who aren't oncologists, translate that. What does a multipeptide vaccine actually do, and what on earth is a CDK9 inhibitor?
Fair question. Let's start with GPS and the WT1 target. So, WT1 is a specific protein. In healthy adults, this protein is mostly dormant.
It just sleeps.
Basically, yes. But in many aggressive cancers, it suddenly wakes up and becomes overactive. What the GPS multipeptide vaccine does is act like a highly specific wanted poster for the patient's own immune system.
A wanted poster.
Exactly. It takes tiny fragments, which are the peptides of that WT1 protein, and introduces them to the body.
Okay.
It essentially trains the immune system to recognize that specific protein barcode. It hunts down and destroys the cancer cells while theoretically leaving all the healthy tissue alone.
So it's turning the body's own defense mechanisms into a targeted strike force against this specific protein.
You got it.
Okay, and what about the CDK9 inhibitor?
Think of a cancer cell like a runaway factory. It is constantly churning out new instructions to keep multiplying and surviving.
Just nonstop production.
Right. A CDK9 inhibitor basically cuts the power cable to that factory. It blocks a specific enzyme that the cancer cells rely on to transcribe their deadly genetic code. Without it, the cancer cells essentially starve and die off.
That sounds incredible in theory, but who are these therapies actually for? Like, who is the target patient here?
This is a crucial part of the thesis. Both of these therapies are primarily targeting patients with acute myeloid leukemia, or AML. Specifically, they are going after relapsed and refractory AML patients.
Meaning patients who have already tried the standard treatments and had the cancer come back?
Or they simply didn't respond at all the first time.
Right.
Precisely. These are individuals with a critically high unmet medical need. Traditional chemotherapies have failed them. Their options are tragically limited.
It's a very desperate situation.
It is. By stepping into this specific arena, leveraging the immune system and cutting off the cancer's transcription engine, Sellas is operating in a space where there are very few viable alternatives. If they succeed, they practically own this highly desperate, highly lucrative segment of oncology.
So the $26 million cash burn is essentially the high-stakes price of admission to potentially hold a monopoly on a critical area of cancer treatment.
Exactly.
But I still have to bring us back to the valuation side of that equation.
Of course.
The market cap right now is sitting at $211.65 million. The return on equity is deeply negative at native 56.85%. How does the market rationally justify a $211 million price tag on an enterprise losing $26 million a year with deeply negative returns?
It requires a complete shift in how you evaluate assets. You also have to look at their price-to-book ratio,
Okay.
which is sitting at a very steep 14.3x. Now, in a normal sector, say, banking or manufacturing, a PB of 14.3 on a money-losing company would be laughably absurd.
It would be an immediate sell.
Right. Normally, the book is your tangible assets, real estate, inventory, cash. But in late-stage biopharma, the tangible book value is practically irrelevant. That 14.3 ratio represents a massive market premium on invisible assets, their intellectual property, their patents, and the sheer probability of FDA approval.
So the market is completely ignoring the present-day reality and pricing in a future that doesn't even exist yet.
In a way, yes. Analysts are currently forecasting significant earnings growth and potential profitability within a 3-year window.
3 years.
But that entire financial projection rests solely on the successful commercialization of this pipeline. The market is looking past the current $26 million cash burn and trying to price in the potential hundreds of millions or even billions in revenue if GPS actually crosses the FDA finish line.
It's an all-or-nothing bet on the science, pivoting to the technicals and price action. If the underlying biology is essentially a high-stakes coin flip until the clinical data officially drops, how are traders actually pricing that risk on the charts right now? Because looking at the action, the technicals seem completely detached from that zero revenue reality.
The charts are telling a story of aggressive, unbridled optimism. If you look at the price action, you can see exactly when the streets started placing their bets. This current explosive uptrend really kicked into high gear on February 12, 2026.
I remember that move.
Right. Since that specific date, we have seen a price change of positive 68.17%. And structurally speaking, the trend is remarkably sound. The stock is currently trading well above its 50-day moving average, which is sitting down at $3.96. And more importantly, it is miles above its 200-day moving average of $2.56.
For the technical traders listening, establishing support above both of those long-term moving averages is the textbook definition of institutional momentum. But stocks don't just go up in a straight line, no matter how promising the science is. Let's map out the actual battleground on the chart. Right now, the core support levels, the structural floor where buyers have historically stepped in to defend the price, are sitting between $3.45 and $4.13. That is your safety net. On the flip side, we have significant resistance looming heavy above us at the $6.32, $7 range.
That resistance zone is the ultimate proving ground. If the stock can muster the strength to orchestrate a breakout above that $7 ceiling, we are entering blue sky territory.
Nothing holding it back.
Exactly. A confirmed breakout there could trigger massive accelerated gains, simply because there is very little historical price memory above that level to act as friction. There are no trapped buyers from 3 years ago waiting to sell and just break even.
But pushing through a heavy resistance ceiling like $7 requires an immense amount of buying pressure. You need sheer, undeniable volume.
You do.
And looking at the data, that seems to be exactly what is building up. I had to double-check these numbers earlier because they are just staggering for a company of this size. Over a recent 5-day stretch, we saw an average of 41.29 million shares trading hands.
That is huge.
On the day it hit that recent 52-week high of 5.42 cents, nearly 5 million shares were transacted. What is driving that kind of trading frenzy?
It comes down to one critical underlying metric, and it is something every potential investor needs to be acutely aware of. The short interest on this stock is over 27%.
27%?
Yeah.
That is an enormous portion of the available float betting directly against the company.
It is. But ironically, that high short interest is acting as absolute rocket fuel for the current upward momentum.
Let's unpack the psychology of that for a second. Why would so many short sellers be betting against a company developing a potential cure for a desperate form of leukemia? Do they know something we don't?
It is rarely about knowing some dark secret. It's more about playing historical probabilities. Right. The cold, hard truth of the biopharma industry is that roughly 90% of oncology drugs fail in clinical trials.
90%. Wow.
They either don't work better than the standard of care, or they prove too toxic. Short sellers look at a company burning $26 million a year with a highly complex mechanism of action, and they bet that the final phase 3 data will simply regress to that historical mean of failure. They are just playing the odds.
But when a stock with 27% short interest starts pushing up against new 52-week highs, those odds start to feel incredibly dangerous. Those short sellers are bleeding.
They're deeply underwater.
And if a positive catalyst hits the wire, they are forced to buy back the stock in the open market just to cover their positions and stop the bleeding, which in turn forces the price even higher, triggering more shorts to cover.
It is a textbook short squeeze setup.
Which perfectly explains why the momentum we are seeing is so violent right now. Moving over to sentiment and market perception, it is a tug-of-war between fundamental skepticism and clinical optimism. And when we look at how different factions are perceiving this setup, we uncover a really fascinating divergence.
You really do.
The disconnect here is incredible. If you just look at the quantitative algorithms, the cold, emotionless bots that scrape balance sheets and assign a mathematical score, they rate the stock as strictly neutral. They give it a flat score, 0 out of 10.
A 0.
The algorithms see the 200% run-up, they see the negative cash flow, the absolute lack of revenue, and they basically throw their digital hands up and say this is uninvestable based on current metrics.
Because an algorithm cannot read FDA tea leaves. It cannot quantify the biological efficacy of a multi-peptide vaccine.
Right.
But if you step away from the bots and look at the human element, the analysts who are actually reading the clinical data, the mood is cautiously optimistic. And really, it's leaning heavily bullish. The consensus analyst rating right now ranges from a hold to a strong buy. And do you remember that heavy resistance level we mapped out earlier?
The $7 ceiling.
Right. That $7 level also happens to be the consensus price target among Wall Street analysts.
Interesting.
From the current trading levels, hitting that $7 target implies up to a 248% upside. The human analysts are looking at the potential monopoly in the AML space and concluding that the future reward vastly outweighs the present-day fundamental risk.
But the timeline for that risk-to-reward scenario isn't some distant date in the future. It is incredibly compressed. Let's look at the catalyst calendar for the next 3 months, because this timeline is exactly why the volume is spiking right now.
The clock is ticking.
First up, we have earnings approaching rapidly on March 18th, 2026. Now, keeping in mind that they are pre-revenue, earnings calls for a company like this aren't about EPS beats or revenue misses. It is entirely about management commentary, cash runway updates, and pipeline guidance.
The earnings call is really just the appetizer.
Exactly.
The real event, the massive binary catalyst that is keeping traders awake at night, is the rumor on the street regarding the Regal Phase 3 readout for GPS.
That's the bibler.
As of early March 2026, the institutional expectation is that this clinical data could drop any day. This is the ultimate make-or-break moment for the entire company.
No pressure.
Right. This specific data readout will dictate whether that $7 price target becomes a reality, triggering the mother of all short squeezes, or if the stock violently plummets back down to its moving averages.
So zoom out for us for a second. Are they operating in a vacuum here, or is the broader macroeconomic environment playing a role in this 200% surge?
The macro environment is providing some incredibly strong tailwinds right now. First, we are witnessing a significant sector rotation. Institutional biotech capital is heavily flowing into oncology specifically.
Because of the unmet needs.
Yes, driven in part by the rising global prevalence of conditions like AML. Second, the broader economic picture is shifting in their favor. The potential for interest rate cuts on the horizon is a huge fundamental boost for clinical stage firms.
Because lower rates mean cheaper access to capital, which is the lifeblood of a company burning $26 million a year.
Spot on. And finally, they aren't just relying on macro trends. They're making strategic business moves. They recently secured a positive agreement for their European study of SLS 009. It's called the Impacts AML Agreement.
Okay, what does that do for them?
This isn't just about expanding trials. It adds a layer of international, institutional validation to their entire pipeline.
All right, we have spent a lot of time talking about the upside, the $7 target, the short squeeze potential, and the promising science. But if you are going to put your hard-earned capital into an asset with a beta over 2.2, you need to understand exactly how things can fall apart. Let's flip the script and execute a deep dive into the bear case.
Well, I have to.
Risk number one is the brutal, unforgiving reality of the biopharma sector: clinical trial failure.
It is the ultimate cliff edge in investing.
If this imminent regal phase 3 readout for GPS disappoints, if the data doesn't hit the primary endpoints for patient survival, or if a sudden glaring safety profile issue emerges, that 27% short interest completely flips from being rocket fuel to being an absolute anvil.
It will drag them down fast.
The current price momentum assumes that success is already heavily baked in. If they fail, the drop will be catastrophic because, as we discussed, there is no fundamental revenue floor to catch the stock. It's a very long way down.
And a clinical failure leads directly into the second existential risk, which is funding dilution. As we established right at the beginning, they have a $26 million cash burn and zero revenue. They're currently trading at an elevated price-to-book ratio of 14.3x. Fundamentally, this company is significantly overvalued unless they achieve immediate, undeniable clinical success.
The clock is ticking relentlessly. If there is any delay on the path to profitability, whether it's the FDA pushing back and requesting more data, a trial enrollment delay, or just an unexpected hurdle with commercial manufacturing, they will simply run out of money.
Yes.
And when a pre-revenue biotech runs out of cash, they only have one card left to play. They have to issue new shares.
Dilution.
They will be forced to dilute the current shareholders to keep the lights on and fund operations. If you buy in now at $5.42 and they are forced to dilute next month at $3, your slice of the pie just got significantly smaller and less valuable.
Those are very real, very potent threats to the share price.
Yeah.
However, to mitigate that financial risk, you have to look at how management is maneuvering behind the scenes.
Right.
They aren't just flying blind and hoping for the best. Those strategic partnerships we mentioned, like the Impact AML agreement for their European study, they're designed specifically to help shoulder that massive financial burden.
Sharing the costs.
Exactly. By partnering with larger entities or securing international grants, they can essentially use other people's money to offset some of those exorbitant clinical costs. This extends their cash runway, thereby reducing the immediate, desperate need for punishing shareholder dilution.
It's a delicate balancing act. They have to keep the narrative and the science strong enough to maintain a high share price so that if they do eventually have to raise capital, they can get the money they need by selling far fewer shares, minimizing the pain for early investors.
Precisely.
So, bringing it all together, what's the final verdict?
While synthesizing the clinical potential with the harsh financial realities, it's a fascinating setup.
After running all the data, analyzing the fundamental cash burn, tracking the technical momentum, and weighing the massive binary risks of the upcoming readouts, the quantitative research models give this a bullish score of 8 out of 10.
That is a remarkably strong conviction score for a clinical stage biotech company.
It really is.
If we were doing the elevator pitch for you today, it boils down to this. Sellas is primed for explosive upward movement driven almost entirely by its WT1 immunotherapy moat. You have a consensus Wall Street analyst target of $7, representing immense upside potential.
Massive.
And most importantly, you have the imminent Phase 3 regal readout that is going to act as the primary spark. The 200% surge of the last 6 months is strong evidence that smart money is already positioning themselves for a highly positive outcome.
But how you choose to play this really depends entirely on your personal risk tolerance and your timeline. There are two very distinct horizons here.
Let's hear them.
Horizon 1 is the short-term swing trade. You are essentially playing the volatility leading into the March 18th earnings and this imminent Regal readout. You are riding the technical momentum using tight stop losses around that $3.45 to $4.13 support zone to protect your downside. And you are trying to capture the violent short squeeze if the data drops and it is overwhelmingly positive.
Right. And Horizon 2 is the multi-year hold.
Okay.
If you look at the science of GPS and SLS 009 and believe it is undeniable, your strategy changes. You accumulate shares, you weather the immediate violent volatility of the upcoming data readouts, and you wait for the full commercialization of their oncology assets.
Playing the long game.
You are placing a bet that within 3 years, this is no longer a money-losing clinical trial machine, but a highly profitable enterprise dominating the relapsed AML space.
Two very different, equally valid strategies for a stock that is absolutely guaranteed to give us some wild price action in the coming weeks.
Yeah.
But before we go, I want to leave you with this to consider. If targeted immunotherapies like the multi-peptide vaccines Sellas is developing actually work and can be scaled, we aren't just looking at a financial windfall for one specific ticker symbol. We might very well be looking at the beginning of the end for broad-spectrum, highly toxic chemotherapy as the default standard of care.
That is a world-changing shift.
Something to think about as you watch these charts. As usual, before we sign off, subscribe, like, and comment to this video to support the show. Let us know down in the comments if you are playing the short-term swing or holding on for the long-term commercialization. Thanks for joining us, and we will catch you on the next one.